Shinshin World View, know about the world together. Fed tapering, shifting debt crisis to other 17 countries, Vietnam, India may go bankrupt as a result. The Federal Reserve's policy of raising interest rates has now been settled. In the foreseeable future, the Fed may also raise interest rates continuously due to economic problems and high inflation. Meanwhile, the tapering process of the $9 trillion liability table officially started in June. Tapering is the key to a downward spiral in the world economy. In order to keep the economy from building up to explosive levels, the US must artificially tighten before the scale of inflation reaches the tipping point, allowing the economy to show a slow decline and slow rise. Economic tightening will cause economic volatility in the short term. The US dollar is the world's leading reserve currency and the settlement currency, and dominates foreign exchange and commodity pricing power. The impact of this operation is therefore inevitably global, with the crisis caused by the contraction of the dollar economy being passed on preferentially overseas. This is determined by the very nature of the dollar economy and the US. The background to this Fed rate hike and tapering is an economic environment of massive overdraft from the start of the epidemic. Beginning in 2020, the US issued nearly unlimited amounts of dollars over a 2-year period in order to retain economic vitality and grow employment in the face of the epidemic shock. As of 2 June, total US federal debt had reached a record high of $30.49 trillion. Under the current Fed policy, the next annual balance sheet drawdown will be more than $1.1 trillion. If the late results are poor, the Fed is likely to accelerate again, achieving a reduction target of about $4 trillion in 3 years, bringing the US balance sheet back to its original position of $4.5 trillion in 2025. Against such a backdrop, market expectations for a 50 basis point Fed rate hike in September have re-increased. Fed Governor Waller then declared to the public that he supports continuing to raise the policy rate by 50 basis points each in the next few meetings. He also said that he would not change that view until he saw inflation fall closer to the Fed's 2% target. The dollar economy is global and highly leveraged. A $100 million drawdown means hundreds of millions, if not billions, of dollars disappearing from the market. Especially in the last few years, it was inevitable that dollar capital, which had flowed in large quantities to fragile markets with high foreign debt and low foreign reserves in the era of dollar overdraft, would then withdraw from the markets, thus indirectly transferring the risk of US debt and inflation to fragile markets. The US is about to begin a global scourge. Over the past decades, the US has used this tactic to reap the rewards of South America, Japan, Europe and other country regions. Today, however, it is the emerging developing countries that are taking on greater risks. These countries, including Vietnam and India, are countries that have developed very rapidly in the past few years with high GDP growth rates, but because of the lack of sufficient foreign exchange protection and their reliance on dollar debt, these countries will be the first victims of the interest rate hike and contraction table. Alarms have now been sounded in the Vietnamese economy, where total debt is about 145% of the country's foreign exchange reserves. Its total debt is about $160 billion and its foreign exchange reserves are about $110 billion. This gap is still based on the premise that Vietnam's foreign exchange reserves are at an all-time high. According to the audit of Vietnam's state accounts, as early as 2016, Vietnam's debt reached 63.6% of the country's GDP, suggesting that the growth of the Vietnamese economy over the past years, and what was once called the Asian economic miracle by the Western media, was built up on a huge pile of dollar debt. After the start of the dollar austerity policy, a huge amount of dollar left Vietnam. The Vietnamese stock market has seen its market capitalization fall by around $70 billion since the Russia-Ukraine conflict and the Fed's interest rate hike, and the wave of stock market selling has been unstoppable, inducing a chain of sell-offs in a knock-on effect, with foreign investors selling a net of up to VND for $20 trillion in portfolio financial assets. VND for $20 trillion of foreign capital fled the stock market, almost 2.91 times more than in the same period last year. The reduction in the overall market value of equities means that these funds are substantially leaving Vietnam, which is disastrous for a country of Vietnam's size, and the vulnerability of the Vietnamese economy is being exposed in this crisis. If the chain of selling cannot be stopped and dollar capital leaves Vietnam with the interest rate hike and tapering, the Vietnamese economy will return to its former self overnight. As the circulation of the dollar decreases, Vietnam will gradually run out of US dollar foreign exchange and fall into a debt crisis, eventually causing the country to go bankrupt. India will be similarly unlucky. India's total public debt is about $1.78 trillion, with a debt-to-GDP ratio of nearly 60% based on India's GDP of about $3 trillion in 2021. And according to the latest data released by the RBI, India's foreign exchange reserves have fallen to $600.423 billion. The above total debt is equivalent to 296% of India's foreign exchange reserves. This shows that the Indian economy has actually been unable to make ends meet for a long time and is deep in the black hole of dollar debt. The Economist magazine believes that the Indian economy may be set back 25 years. Western capital has already begun to quietly withdraw from India, and some Wall Street investors began to stop investing in India years ago. Investors recognize the speed and potential of India's economic development, but the risk of a potential debt crisis and fiscal insolvency in an era of economic downturn has significantly outweighed the lure of India's economic development potential for investors, and a debt-ridden India could well become the next Sri Lanka. And according to comprehensive data from the IMF and the World Bank and other institutions, Argentina, Turkey, Sri Lanka, Brazil, Pakistan, Malaysia, Egypt, Indonesia, Mexico, Lebanon, India, Vietnam, Nepal, Myanmar, Mongolia, Thailand and Peru are at least 17 countries that may have fallen into the US dollar debt trap and will be trapped due to high debt levels and do not have strong foreign exchange reserves to support them. The plight of the US dollar in a new cycle of monetary tightening. In other words, the US is passing on the risk of debt and inflation to at least 17 countries through a single hand. This is a means of harvesting the wealth of developing countries to help the US through this difficult time. This is something the world needs to be wary of. The current energy and food crises are taking turns, natural disasters caused by climate change are frequent, the new coronavirus is still threatening the security of all humanity, and global supply chains are tending to collapse again. The global economy has inevitably gone into a downward trend. In a downward spiral, the US's self-preserving economic policies could trigger a global cascade of economic explosions, extending from highly indebted, low-storage countries all the way to the developed world, with the likelihood that the US will not be spared in the end. The US is now much like a crocodile creeping in a puddle during the dry season, choosing to eat its way through the herd of beasts drinking water to quench their thirst, but with less and less water in the pond. Such self-preservation at the expense of others will not change the situation when the pond eventually dries up and dies together. Welcome to subscribe and like it. If you have a new perspective, feel free to leave a comment for discussion.